If there's a stock that you like and you want to trade, but you notice that it consistently trades sideways for a certain period of time, then iron condors might be a strategy you should really consider. What's up, guys? Welcome back to Modern Options. Would you kindly leave a like on the video? It really helps out a small YouTuber get picked up by that almighty YouTube algorithm. All right, enough talk. Let's go ahead and get right into the video. If you've already looked up iron condors before, you might have gotten really confused when other YouTubers describe how to enter into one. It's really not too hard to understand as long as you have a basic concept of credit spreads down pat. An iron condor is similar to a credit spread, where you're receiving a credit in the hope that the IV will drop, stay within a certain range, and expire worthless or allow you to at least capture 50% or more of the premium. And if it expires worthless, this lets you keep all the premium that you received up front. But as opposed to a credit spread, which is a two-leg option strategy, an iron condor is a four-leg option strategy. That's because an iron condor just combines a put credit spread and a call credit spread into one trade. So where in a put credit spread, you want the underlying to close above your short strike price, and a call credit spread, you want the underlying to close below your short strike price. That just means for an iron condor, you want the underlying to close and remain range bound between those two short strike prices. That's the simplest explanation that you're going to be able to find on the internet for an iron condor. So your stock can go up, down, sideways, even go out of range, so long as it comes back down in between that range by expiration, you get to keep all the credit that you received. So you're basically getting double the credit. So one of the beauties of this strategy is that even though you're entering into two different credit spreads at one time, your collateral requirement is not going to double. Since the underlying only has one closing price at expiration, it's impossible for both of your short legs of your iron condor to close in the money. Only one side of your iron condor can be tested if the underlying price gets close. One of them is going to be in the money and one of them is going to be out of the money. So that's why you only need enough collateral to cover one side of your credit spreads. This is great also because you're basically getting double the premium for putting up the same amount of collateral. But obviously it comes at a cost that you have to stay within that range, and it can't be overly bullish or it can't be overly bearish. So also there's some considerations that since you're trading 4 contracts at once with this strategy, and if you trade with a broker that charges per option contract, you'll have to factor that in for your profit and loss. For example, TD Ameritrade charges 65 cents for their option contracts, and usually there's a regulatory fee about like 1 cent or like 4 cents or something. So somewhere in the ballpark of $2.70 to enter your trade and the same to exit. So it's going to be a little over $5 to get in and out of the trade. Remember to keep that in mind when you're determining your profit and loss marks. As well as your iron condor will have 2 break-even prices. And those are calculated the same way as a credit spread. On the put short strike, you subtract the premium that you received from your strike price, and that's your break-even to the downside. For a call credit spread, you add the premium that you received to your short strike price, and that's your second break-even point. So if the stock falls anywhere in between your break-even prices, then you will have either made money or come out of the trade break-even, not accounting for any sort of brokerage fees that you may have. All right, so let's go ahead and show you a quick example on the Robinhood platform. So one stock that is pretty range-bound often is AT&T. And by the way, guys, none of this is a recommendation for you to buy or sell any of the stocks that I do a video on. Always trade at your own risk and do your own research and due diligence. So let's just go ahead and look at the monthly and 3-month charts. So on the monthly chart, it's looking like it was range bound between about 27.90 and 30.33. And then 3 months, you can see this is pretty neutral as well. Going as low as $28, as high as $31, but the average highs were floating somewhere around the high 29s. Oh, so even down here to the $28. So using that knowledge, we can go ahead and go and trade options. Let's just say we want to do one about 30, 45 days out. Let's do the April the 23rd. So let's just say we expect it to still trade within that range. So let's go ahead and set up our call credit spread first. So for me, I always like to personally enter my credit spreads by entering my short strike first. That way I can see this chance of profit column, and it's just mentally easier for me. I don't know. So we want to look at the open interest, that we at least have some buyers in there, as well as daily volume. So not crazy volume, but we at least got over 100 people trading these options, so shouldn't be too bad. So we saw that to the upside, it went somewhere around $31. So if we wanted to give ourselves a little bit of extra padding, we might go to the 31.5. So it's going to give us about an 80% chance of profit to the call side. So we're going to go ahead and click that. That's our short strike for the call side. Go ahead and buy our long strike for our call credit spread. Let's just make this Iron Condor $1 wide, or putting up $100 in collateral. So for that, we just add $1 to the strike price over to the 32, and let's go ahead and add that in there. So you can see already this is just a call credit spread if we were to do this by itself and get 14 cents credit for putting up $100 worth of collateral. But we're not doing a call credit spread, we're doing an Iron Condor. So now we have our call credit spread side. Let's go ahead and make our put credit spread side. So it floated down to about 28 or a little bit below. Let's give ourselves a little bit of extra padding. Let's go to 27.5. And you can see that's giving us about the same percent chance of profit, right around 80%. I don't like the volume on that though, only being 12. I want something a little bit more liquid. And these are not as liquid as the calls, which I do not like. But for this example, just going to go ahead and show you how to enter it. I probably wouldn't enter this trade myself. I just don't like to see that low of volume. But we'll go ahead and do it at the 80% chance of profit. We would sell the 27.5, and then we would buy the 26.5. You should be able to see up here, Robinhood will recognize this as an Iron Condor if you entered all of your contracts right. That would give us a total credit of about 23 cents, which is about 23% return on profit on a $100 investment, which is not too bad if you just think that AT&T is going to stay within this range for the next month. So you click continue, and you can see that it's only going to require the same amount of collateral. We only want to enter one of these. Let's say that we want to wait for a good price to enter, so maybe we'll enter in 25 cents. Minimum credit that we'll receive is 25. When you review the order, you should see that the collateral is $100 once you enter in. This is an Iron Condor, so you're definitely receiving a credit for this trade. Make sure you click that, then submit, and then you're in an Iron Condor. All right, so now let's go over how to open one on Thinkorswim. So I think the reason why I had low volume is because I picked the wrong contract. So the 16 April is actually the monthly one. You can see there's a lot more open interest on both the call side and the put side. But anyways, if we want to go back to that 31, so we're opening up the Iron Condor on the call side first. So we're going to go ahead and sell that 31 strike. You see it pop up down below. And remember, when you're doing multi-leg option orders on Thinkorswim, you have to control click in order to get more of them. So to finish out the call credit spread, control click on 32. There we go. We got the credit right there. And now let's go up to 27. Give us that extra padding. I'm going to go ahead and sell that first one, 27, and then buy the 26 right below it. And this is going to bring in 28 cents. Then you're able to go ahead, confirm and send, and get into your trade. All right, guys, that's a quick down and dirty video on entering Iron Condor spreads. I like to keep my videos relatively short. I know there's so many other YouTubers out there that just have 20, 30 minute plus videos that go way more in depth. If you want to watch those, by all means, I can recommend some to you, but I wanted to get you guys some videos that you can digest quickly and hopefully explain to you so you understand it a little better. As always, leave a comment below if you need any more clarification on anything I discussed in the video, and I'm putting videos out every week, so make sure you subscribe so you don't miss out.